As you settle into your marriage, you realize that you've lost your freedom with respect to many aspects. From having to share your bed with someone to having to jointly decide what is to be made for lunch, it is but natural to think that when it comes to investments, your investments are also going to be as a single person. While in general that is the common thinking, in reality, taxation has a different role for your investments as a couple. In many countries, when you get married, from a taxation point of view also you get taxed as a couple, meaning both your incomes are added together and a single return is filed for both of you together, which is a couple return or a family return, and that will suffice for both the individuals. Well, that is not the case in India. In India, both the individuals are treated as two separate entities and they are taxed for their respective incomes. There is no provision to mix both the incomes together or file a single return as a family return to the government. Because you are treated as two different individuals even after marriage, your incomes are treated as two different streams. That is why it is extremely important that you keep a wall between the cash flows of both of you as spouses within a couple and keep them separate and keep them distinct, so that tomorrow there are no complications from a taxation point of view when you have to file your returns and disclose your income to the government. Let's take up the example of Ki and Ka, where Ki is working and Ka is a homemaker. We've already discussed where Ki is the income earner of the family and she, from whatever earnings she has, will transfer a part of her income to the joint expense account, through which both she as well as her spouse Ka can make the spends towards the regular expenses that they need to maintain their lifestyle. In addition to doing that, Ki also needs to transfer money from her salary account to her investments account so that she can save for the future goals that they have as a couple together. Now the first question that gets asked is, what is the implication of money given by Ki to Ka for the sake of the regular household expenses? Well, it is pretty clearly stated that any money received by a spouse for the sake of household expenses is not chargeable to tax, and there would be no tax implications on the money which Ka receives from Ki for the sake of the household expenses. In this scenario, you can see that Ki earns a salary and she pays taxes on that salary to the government. In addition to that, whatever investments she does, she would be earning certain investment income from those investments as well. It can be in the form of interest, in the form of dividends or capital gains. But whatever income she earns on the savings that she's putting aside and investing them, that again is going to get taxed because that is her investment. So it was a very common practice wherein the earning spouse would transfer money from his or her account to the non-earning spouse, so that when the investment happens in the account of the non-earning spouse, those earnings from those investments get taxed in the account of the non-earning spouse. And in most scenarios, the non-earning spouse would not have any other income, so it will only be the investment income, and as a result of which you land up paying either zero taxes or paying taxes at a lower rate, because that is your only income and you will land up in the lower slab of income tax. To put a curb on this method used to reduce the overall tax liability of the family, the government introduced something which is known as clubbing of income. Now, what exactly is clubbing of income? Let me show you. Now, in this case, since Ki is the only family earner and Ka is a homemaker, Ki decides that instead of investing a lakh of rupees in her account, she gifts the money to Ka and it is transferred to the bank account of Ka. Ka goes ahead and invests the money in a fixed deposit, and that generates an income of 8,000 rupees at the end of the year. Now, in a normal scenario, the 8,000 rupees would have been an income for Ka and he would file it in his income tax return. But since there is this provision of clubbing of income, which is as a part of the Income Tax Act, what happens here is the 8,000 rupees which is generated as an income in the name of Ka will not be filed as an income of Ka. Instead, it would go and get clubbed with the income of Ki. So what is happening here is the government has taken away this method which was used by many to reduce their overall tax outflow by stating that any income which is gifted by a spouse to the other spouse, and when they go ahead and invest the money, the income will go and get added back to the income tax return of the spouse who gifted the money, right? So in this case, the income goes and gets added to the income tax return of Key. So whether Key invested the money in her name or her spouse's name, it would not have mattered, because eventually it would go and get clubbed as her income and she will have to pay taxes on those returns. That is why it is extremely important that you are aware of this provision wherein you freely transfer money to your spouse's account and they invest the money. You should have a clear trail of what money belongs to you, what money belongs to your spouse. So the income earned from your respective original capital only gets taxed in your individual returns. Any mixing of income will only complicate taxation for you as a couple. If you are a couple in which only one of you is an income earner and the other one is a homemaker, the best way for you to plan your taxes is that you invest money in the name of the non-earning spouse in the form of putting the money in a PPF account. Now, it's very clear that any interest that is earned on your PPF account is tax-free. So when you invest money in your spouse's name and put that money in his or her PPF account, what happens is that income would get clubbed with your account under the clubbing provisions. But since that interest income is tax-free, you do not have to pay any taxes on that particular income. So that is one of the ways in which you can plan your taxes, that when you invest the money in your spouse's name, invest it in an instrument like a PPF account where the earnings from that account are tax-free, and even if that money gets clubbed with your account, there is no impact of taxation for you. A second way in which couples where only one of the members is an earning member can plan their taxes well is that whenever you receive a gift, you take the gift in the name of the non-earning member. Now what happens there is that when you receive gifts as a non-earning member, whatever gifts that you receive, if they are beyond the prescribed limits, then that gets added to your income. But you have the exemption up to 3 lakhs per year where there is no tax on income up to 3 lakhs. So gifts up to 3 lakhs would be tax-free in your hand, and gifts beyond that limit also would be taxed at a lower rate versus taking the gifts in the name of the earning spouse. In addition to that, the second benefit of taking gifts in the name of the non-earning spouse is that when the gifts is treated as the income of the non-earning spouse, they can go ahead and invest the money in interest earning, dividend earning or capital gain earning instruments, and those will be taxed in their individual's name and will not be clubbed with the income of the spouse. The reason being that this is not a money which they have received as a gift from the spouse. This is a money which you received as a gift either from relatives or from friends. So when you receive the gift, you treated the gift as yours. So it's your money that you're investing, and whatever earnings that you have from your money will be taxed in your individual return and will not be clubbed with the return of your spouse. So in these small ways, every year you can save a good amount of tax, which over a long period of time can be a substantial saving for you as a couple.